I'm Motley Fool Canada senior analyst Nick Seipel, and this is the 5-Minute Major, here to make you a smarter investor in about 5 minutes. Today, we're discussing the latest earnings from BCE Inc., the company formerly known as Bell Canada Enterprises. My guest today is Motley Fool Canada Chief Investment Officer Ian Butler. Ian, thank you for joining me.
Great to be here, Nick. Sun is shining. North American markets are up. All good.
Yeah, not all good if you're a BCE shareholder,
Sure.
though. This morning, shares fell as much as 2% this morning, have bounced back a little bit in response. The first quarter 2024 earnings results continuing a skid has the stock down nearly 15% so far this year. Ian, what didn't the market like about this earnings release?
Yeah, from my take here is that it's really just a continuation of a theme, Nick, because BC's, you mentioned the year-to-date stock price performance. BC's stock price is effectively where it was a decade ago. It's sort of in the mid 40s, and that's where it was back in 2014. And all that means is that investors, by owning this stock for the past decade, really all they've earned are the company's dividend payments. And we'll circle back on the dividend situation. But I mean, if we zoom in on the company's earnings release and try to come up with an answer there, I think the issue is growth, and it has been for the past decade, or really a lack thereof growth. There's some push and pull throughout the report. Some areas are growing by sort of low single digits. Some areas are shrinking by low single digits. But overall, the company's income statement is pretty much as it was back in 2014.
Yeah, Ian, you're not painting a pretty picture here, but if you had to look at the sell-off, potential opportunity in the business does have a pretty high dividend yield when you look at that number. Or do you have long-term concerns about this business, maybe about the dividend itself?
Totally. Yeah. BC fans will absolutely point to the dividend, and it's admittedly quite an attractive number. 8.7% is pretty good. That has the potential of beating the market over the next decade just on its own. But for me, I tend to lean towards concern, more concern than not, actually, about that dividend and about the company's financial health overall. So I mentioned the income statement really hasn't moved since 2014, much as it was. There are some metrics, however, on other financial statements that have moved, and I'm talking about the company's total debt and BC's dividend payout. So total debt has gone from $15.5 billion at the end of 2014 and now sits at $37.7 billion, so more than double. And again, BCE is no more profitable today than it was back in 2014. And the per share dividend has gone from $2.47 to $3.99, and that's a 61% increase. That's occurred without a similar increase in the company's free cash flow. About free cash flow, over the past 12 months, BCE generated $3.3 billion in free cash flow. Its dividend obligation was $3.5 billion. So BCE is not generating enough free cash flow to cover its annual dividend payout. And at some point, that's just not sustainable. Something's got to give on that front. And I think, to me, that's a situation I'd prefer to let somebody else worry themselves about. And I'm happy to be on the sidelines as BCE tries to figure out where to come up with the cash to pay that dividend.
Yeah, great lesson on not just focusing on the dividend yield. What's the greater context the company's operating in to kind of be able to deliver that dividend? Is that sustainable? So in that light, Ian, you spend a lot of time here at the Motley Fool Canada looking at dividend paying stocks of all kinds. If you had to think of another place Canadian investors might be looking for a reliable dividend stock to provide income for them outside of BCE with its concerns, what's a company that comes to mind for you?
Totally, and we can loop. You've spent a lot of time, Nick, sort of on this situation around energy and a lack of energy to meet the forthcoming demand, I think, across North America. So a company that comes to mind is Fortis. Fortis is a Canadian utility company, North American utility company, really. Offers a 4% plus yield, and I think they're very well positioned to be a beneficiary of the growing demand for energy across North America.
Yeah, I mean, another one that comes to mind if you're thinking about Canadian Energy Tourmaline Oil Corp, one of the biggest natural gas producers in Canada. The yield might not look that high when you just take a glance at it. However, they pay regular special dividends that make that payout pretty robust, and I think there's opportunities for it to grow over time. Well, with that, we're out of time here at the 5-Minute Major. Hopefully, we made you a little bit smarter, and we hopefully will see you next time as well. Thanks for joining me, Ian.
Cool on.